Hello there. Good afternoon, everyone. Oliver Kollofski, Director of Wealth Services and Advisor here with Sweet Financial Partners. So welcome to Sweet Financial Live today. A couple things we're gonna go through items for kind of looking ahead to 2024 here. Looking back on 2023 as it relates to the markets, also touch on 2022 a little bit, and then also go through some tax, maybe not necessarily changes, but considerations here as we move forward in 2024. So let's see, questions. If you have questions or anything as we go through our time together today, ideally use the chat box down at the bottom, and it will be anonymous. And I will, if it's a question, I'll answer kind of on the air, so to speak. I certainly won't state your name. If it's a question that's more specialized or unique to your situation, or one that might require a really long answer, I'll acknowledge it, but I'll probably just email you as long as I can tell who it is. Some of you come in as like a phone number instead of a name, so I can't always tell who it is. But if I can tell who it is, I'll answer you kind of one-on-one in an email or a phone call. But yeah, you can use the Q&A box below, or ideally use the chat. So yeah, have a lot of great information to share with you today. So we will go ahead and get started. And I think it's maybe appropriate here. This is more so a coincidence here as we move into the first slide, that the first slide happens to be a thermometer, at least for those of you from Minnesota or in kind of the Minnesota, Iowa, or Midwest. We've of course had really cold temperatures. So how do we relate this back to the financial markets? So if you were to ask me, like, what's the average temperature in Minnesota, let's say. Now, I don't know the answer. I'm sure it varies if you're in like southern Minnesota or northern Minnesota. The answer is, probably somewhere in that 50, 55 range, let's say, as the average temperature in Minnesota. And the average is not 50 degrees because it's 40 one day and 60 the next, or 45 one day and 55 the next. This is, of course, the average, because in the summer maybe it's 80, 85, it's 95, and of course right now down towards zero and below zero. So we can draw a parallel with the financial markets as well. So I'm going to bring up kind of the history of the markets here to help put kind of volatility in perspective, and also put 2023 and 2022 in perspective, because they were somewhat contrasting years as it relates to the financial markets. And again, any questions? So if you see me look off to the side on my other screen here, I've got the questions and chat box. So if you see me look that direction, I'm seeing if we have any questions or comments or anything along the way. So let's continue on. So let's draw the parallel here. Again, average temperature 55 degrees or 50, let's say, in Minnesota, but it's not because it's 50 or 55 the other day. There's a lot of information on this slide here. We're gonna zoom in on it here a little bit. What this is 98 years of data. And in each of these, call it gray, and I'm gonna grab my pen here. So each of these gray items would be a calendar year and their associated return for the S&P 500. So if we look at like 1959, the S&P 500 happened to be up 11.96%. And I just picked a random year though there. So each calendar year and the associated return for the S&P 500 index, which would be like 500 of the largest US stocks. Now, in a moment, we'll go through some things why maybe the S&P 500 isn't always the best item to look at when looking at the markets. But in terms of having a really large data set, the S&P 500 is great because we've got 98 years of data. Whereas if we use other items, we can't go back quite that far. So a couple things to look at here, and I'll zoom in on this on the next page. So 72 positive years out of the last 98. So would that be 73% or so of the time? And negative years, so there's been 26 negative years in the S&P 500 out of the last 98. So it'd be like 27% of the time. And I'm going to go ahead and see if I can look at those drawings and move on. I'm going to zoom in a little bit here. So if we just focus on those two numbers here. What's interesting here is the magnitude. So the average return for the positive years is 21.4%. Even though you may have caught on the last slide, the average return over the last 98 years is like 10%, or just over 10%. So when the market is good, historically, it's really good. And then on the downside, the average return out of the 26 negative years that we've seen in the last 98 is down 13.4%. So we see the magnitude is different there. If we average out the positive years, the positive upside capture is greater than the downside movements there. I'm going to continue zooming in on that same graphic here. So what was interesting about that, and I'll bring the whole graphic up momentarily. If we look at, we have categories here. So if we look in orange, we have, if the market was down 0 to 7%, down 7 to 14, 14 to 21, 21 to 28, and 28 plus, those are all the negative years. And conversely, the blue would be positive, same 7 percentage point increments, up 7, up 14 to 21, and so on. So if we look where what's kind of unique, if you will, or interesting, is where 2022 fell. So going back in time a little bit. There's 2022, if you remember, kind of, virtually everything, unless you own like oil stocks or some sort of commodity, virtually everything went down, stocks and bonds in 2022. So if I bring up here where 2022 was, it was actually right here, of course, in the down 14 to 21% range, which I call it interesting because it's only the second time in a 98-year history that the S&P 500 has been down between 14 and 21%. Which if we asked most folks, most financial professionals as well, I would guess, and I could be wrong, I would guess very few would get that correct. The only other time we saw the market be in that range was 1973. So let's move ahead to 2023. And I'll add a little context to this, but this would be where 2023 falls. That's going to be in the up 21 to 28% range, which that's happened a decent amount of times going back 98 years. So there was 2023. So the third time since, let's say, 99 that has happened. So I've got a question for you. So if we know that, oops, I might have actually spoiled the answer there. If we go, my apologies here. If we know that the average return over the last over the last 98 years is up 10%, how many times do you think that the average has actually occurred in the last 98 years? So that's kind of going back to the parallel or the analogy with the thermometer, that the average temperature is 50, 55 degrees, but it's rarely like 45 to 50 degrees. Or if the average is 10%, intuitively you might think it's between 7 and 14% up a lot, because that's where the average is. So if you think 98 years, how many years did the S&P 500 return between 7 and 14%? So if you give you a moment to think about it, we're not going to do a poll or anything. You don't need to answer, but just got to think to yourself what that might be. And then I'll draw like a conclusion, or how do we actually use that data? Fast forward to the answer. So the answer is, I believe it's 9. So the 9 times, these would be the 9 calendar years in which the stock market returned roughly average. So I'll call it, 90% of the time the market doesn't do its average, which is probably kind of like the weather. Yep. So the conclusion out of this, or as we learn from history and data as the sample size gets bigger, is one, timing the market is extremely difficult. We certainly can see adjusting risk levels, but thinking that the market is going to do something is very, very difficult to prognosticate. The other item is if the market goes up, it typically kind of goes on a run and goes up a decent amount here. And I don't have the data right here, but there's actually a number of times where we'll see, like, when it goes on a run in one calendar year, it continues for a subsequent calendar year or years. So it's 9 times. So only 9 times out of 98 has it actually returned, like within, call it 3 or 4 percentage points of the 98-year average. We'll close out our conversation on this one. This is the one that's occurred actually the most. The most occurrences would be times when the market was up more than 28%. That's the one that has the most. And the least occurrences was the one we highlighted earlier, down 14 to 21%. And here's where it says the average, the 98-year average. So that's some perspective going back to 22, also looking at 23, and also when we think about the markets as a whole. All right, the next item, we've used this analogy before, but mayonnaise is probably a good representation of diversification. I would think for a number of you, you might have mayonnaise on a sandwich or somehow in a salad or something, and it's for some, it's a great ingredient, but I've never heard of anyone having, just mayonnaise for lunch or dinner. It would be ridiculous, of course. So it's kind of like investments, where some investments work as a great ingredient or diversifier, but they would certainly never be the main course. So I'm not going to go into specific types, but just generally when we're thinking about investments, that's how we'd want to think about things as ingredients of a portfolio. So let's add a little bit more data here to what we talked about the S&P 500 before, but let's look at 3 different items. And this is for calendar year 2023. So it doesn't have any 22 data, and it doesn't have any data the first 17 days into to January here. So we can see the purple line was up 26.29%, and that's the S&P 500. The orange line, it would be the Dow Jones Industrial Average. So U.S. stocks, like the 30 of the larger U.S. company. And then the blue line showing up 5.53% for the year. That would be bond. Think of like U.S. bonds, technically the Bloomberg U.S. Aggregate Bond Index. So a few key items here. Normally, and I'll show a chart in a moment, that if we go back in history, the purple line and the orange line, they typically don't have the divergence like we see here, with the purple line being the S&P 500 outperforming the orange line by whatever, that's 10 percentage points there. And if I was actually to look at like 2022, the inverse would happen. The orange would be a much better performer than the purple. So what, a few more comments on that. We saw, and you maybe heard on the news or on the TV, or if you're reading articles, a term called the Magnificent Seven, which was, if you look at the S&P 500 and you picked the 7 best stocks, they accounted for almost all of the return. If you owned the other 493 stocks, your return would have been way less. So that Magnificent Seven would be like Google or Alphabet or Facebook, which would be Meta, Tesla, NVIDIA, stocks like technology-oriented stocks. So those kind of 7 had a huge impact on the purple line, which we hadn't seen that much in the past. The other item, if I was to draw a vertical line, or attempt to, right there, that's going to be right around Halloween time, like October 31st or so. And if we would have looked at the Dow, if we were sitting here on October 31st, we would see that the Dow is, about flat for the year. Bonds were actually negative, and the S&P 500 was up, at that point, call it like 9% or so for the year. So virtually for the Dow, all of the return came in the last 2 months of the year. For the bonds, more than all of the return, because it actually started negative, came in the last 2 months of the year, November and December. And of course, for the purple line, we saw a big ascent in the last 2 months of the year. So part of the reason was we saw some pretty attractive inflation numbers, and we'll talk about that coming up. If we think about like interest rates going forward, we'll talk a little bit about that later, but it looked much more promising. You heard a term like soft landing, and maybe not the recession some folks may have thought at one time. So a lot of it is kind of how the market moves would be maybe what the Fed says as they deliver their rate announcement, and a lot of it was viewed very positively as we ended the year, especially November, but certainly into to December as well. So we included these three charts because if someone says, well, how's the market doing? Let's say, well, it really is going to depend on which market. Of course, we could put, international stocks or small cap stocks or mid cap stocks, emerging market, all sorts of different pieces that we view comprises a diversified portfolio. So that's the look at what we saw the markets do in 2023. A few moments ago, I mentioned that if we were to look back further, like the purple line and the orange line would be more so like one on top of the other. The divergence we saw in 23 was a bit unusual. So let's take a look at that chart here. So this is going back to the end of 2014 or the beginning of 2015. And what we can see is, one is up 174% and the other's up, 15 percentage points or so less than that. But you could see some movement differences in movements in here as it relates to 2022 and 2023. So what we saw in 23 was a bit unusual. Usually the purple and the orange, highly what they would call correlated to one another. Let's change the topic slightly. So if we look at 2024, so let's look at geopolitical happenings from a historical perspective, and I'll comment on a couple things happening right now. So this blue line would be the growth in investing in the S&P 500 again. There's a big data set there. So that's going to be kind of the growth of a hypothetical initial investment. So that's the bold blue line that's going up and down. And then all of the boxes, if you will, or arrows pointing to different wars or geopolitical conflicts. So I'll comment on this from a financial markets standpoint. Historically, the markets have continued to do well, or there's certainly been volatility along the way and periods of downturn, but and this is going back to 1927, so almost 100 years, but still having kind of the upward to the right momentum over time. And we've got the Russia-Ukraine conflict now, Israel, Hamas, now some things happening with the Red Sea and Yemen, so some items happening there. And we'll talk about inflation here in a moment, but there's talk of what's happening as it relates to supply chains, inflation, freight costs, with kind of the bottleneck that's happening in the Red Sea. If I think the number was like, I guess I'm not sure on the number, but it's a fairly high percentage of trade travels through the Red Sea. So should that escalate, that's probably going to would disrupt supply chain. Freight costs would go up a decent amount, causing inflation. So that's where some of these interest rate movements get a little difficult to look at. Some people are saying, well, maybe we'll have interest rate cuts by the maybe next end of this year into 2025. Maybe if there happens to be more geopolitical conflict or continued or escalated geopolitical conflict, maybe interest rates will have to go up a little more. Time will tell. This is kind of a reminder, if you will, of the kind of ongoing geopolitical conflicts, as well as the stock market along that same time frame with the calendar years on the horizontal axis. So I mentioned inflation. So let's go there. So this data, they didn't have it updated quite yet through 2023. But this, of course, is just a reminder going back to 1980. $1 in 1980 is worth, well, 28 cents at the end of 22. So at the end of 23, it would be worth a little bit less than 28 cents. So, of course, inflation is a thing, and I've got some data on it. And where a lot of folks, I think, comment anyway in meetings I have with clients is, food costs, travel costs, that type of thing. It's not like you can just easily say, I'm going to slash my food budget and then I'm going to save money, where I suppose you could slash, a travel budget, but, food, you of course can modify it some, but much more difficult. So this is going to be here this is going to be through February of 23. So this is old data, and I'll show the current one in a moment. But this was February of 23. So think of like a year ago. At that time, year over year inflation was at 6%. It had peaked. If you recall, the peak, I believe, was in July of 22 at like, just over 9%. And it's been coming down ever since. So again, what we're doing here, sometimes the terms get mixed up. This is not deflationary. We're decreasing the rate at which inflation increases. So it was at 6% at the time, and then the orange dotted line, that'd be the 3-year average, was at 5.2. So that was like a year ago. And in a moment here, I'll show the exact same chart, or the same chart with the most recent data added to it, which I believe is through November. Yeah, through November 23rd. So we've continued to see that year over year inflation number drop to where that 3.1% has now fallen below the 3-year average, which rising interest rates will do that. It certainly takes time. Sometimes inflation can be like a train going down the tracks. You can't just apply the brakes and instantly stop. It's something that takes time, or the interest rate increases have to work their way through the economy. So that look from the peak down to where it was, kind of in that 3% range. And again, that's not saying prices are decreasing. It's saying prices are not going up by as much. So the growth rate is slowing on price increases. There have been reports, and I didn't know if I'd ever see this, of actually like supplier. I think this was steel. I don't recall the company, but they'd actually published that they were decreasing prices, which a lot of times people think maybe it's a little bit of a cynical view that when inflation happens, companies always increase prices, and then when prices moderate, do they really ever pass that along to the consumer? So it does actually happen. I've seen several reports of it, of suppliers and then companies decreasing prices. So I would view this as good news here. If we look at individual items, this was May of 23. Yeah, if we look at the number one, there's a year over year, the housing, food, which gets a little bit, everyone's got to live somewhere and everyone's got to eat. Or the two highest things in terms of the CPI, or consumer price index. And when you think that the consumer is 70% of the economy, that can be a little worrisome. And one of the main reasons why inflation needs to be controlled, or have a targeted rate. Kind of the silver lining there was that fuel or gasoline was down 20%, which everyone kind of has to, or for the most part, would use that. So that would be a positive thing. If I fast forward now, and again, housing and food at the time, not quite a year ago, we're at 8, and 7. And I now fast forward to the most recent data. This would be November data as it relates to CPI food, back in that 3% range. Housing still at 7% there. So good news is that number is coming down, if you will. So we'll transition now. So 2024, of course, presidential election year. So let's share some information on that. Sometimes, again, in chatting with clients, folks get a little nervous as it relates to election years in terms of the stock market. So let's take a look at a few things. Again, there's a lot of data here, so I'll grab the pen and look at that. So what this chart does on the bottom, it's going to be every president going back to 1929. And again, in the Republicans down here, it happens to put those in red, and Democrats puts their name in blue. So every president going back to 2029, or excuse me, yeah, 1929 through 2020. So we'll have updated data on this at the end of 24. So now let's direct our attention towards the top. So we look at we can contrast or compare the first, second, or third, or fourth year of a presidential cycle. Which year, we got quite a bit of sample size here, good amount of data. Which year is historically the best? Well, it's going to be the third year at 17.64%. which would have been 2023. It would have been last year. So last year, again, S&P 500 was up like 26% or something. So it actually contributed to that average, or will, once the new data comes out, contribute to that number being even a little higher. The second best would be the fourth year of a presidential cycle, which would also be the election year. So that would be 2024. Yeah. Part of the reason I think, if we look at, is my opinion a little bit, you're probably not going to see any major legislation happen this year. And generally, the financial markets like that. They like things being known. The financial markets don't like surprises. So when there's gridlock, or the likelihood of major legislation being passed is pretty low, probably a good thing for the stock market. It probably contributes to, again, the third or fourth year, things are a little more known than maybe the first or second year. So that's that would be kind of what might happen there. The fourth year, if you eliminate 2008, if you remember, the financial crisis was down big. That was this year right there. So that's if you were to eliminate that, which of course you can't to get accurate data, but if you were, the fourth year would actually be probably a little bit higher on that one. So let's get a little more granular here and look at the actual presidential years, going back to, again, 1928. This would be the year in which the person was elected, not the year they were inaugurated, but the year they were elected. And again, a good sample size, almost 100 years of data here. Again, Republicans in red, Democrats in blue. And we can see that out of those 24 years, so this would be an election year. So after this year, next time I would ever show this chart, we'd have 2024 on there. 20 of the 24 years provided positive returns. There have only been 2 negative years, I believe, since, I thought it was, yeah, 2 negative years since 1940. Because out of the 4 years that were negative was 32 down here, 1940. So we went from 1940 to 2000, so almost 60 years, without having a negative stock market for the S&P 500 index in a presidential year. Now we've had 2000, and then, as I mentioned a moment ago, 2008, which would have been the kind of like September, October of 2008. The some of the illiquidity there, and kind of the financial crisis that unfolded. So that would have been 2008. But I would view this as positive returns. What I don't have here, the data I don't have here, is volatility. I have like starting and ending date, and what would the return be? And the reason I mentioned that, if you think about, let's think about 2020, up 18.4%, which sounds like a good number. If you didn't look at anything from, in terms of your statement, from, let's say, January 1st to December 31st, you open up on December 31st, 2020, say, oh, okay, investments have gone up. Good. But if you would have looked at something in the interim, a reminder that from, and I could be a little off on these dates, but I think it was like February 20th or something like this. This was when COVID or the pandemic began, from late February to call it like April 3rd, I think it might have been, of 2020. The stock market was down 30%. A 30% decline in like a 6-week period. Subsequently returned such that the return for the calendar year was up 18.4%. So historically, election years provide good returns, but certainly volatility involved, and of course, probably a lot of things on the news cycle. More eyes watching the news in presidential election years. Let's talk about opportunity. So everything we've talked about, geopolitical events, the economy, elections, really don't, I mean, we can be informed and make educated and informed decisions, but we really don't have, you and I, like direct control over those things. So we always want to look at, like the good news of opportunities. I'm gonna mention a few things, and then we'll highlight. Let's go a little deeper on a few of those. But so, I mean, there's many, as it relates to financial planning, you and I control many, factors. I'm going to list a few of them, and then we're going to go into details on a few. But, how you contribute or save, is it pre-tax? Is it after tax? From which account you take income and when? You have complete control over that. When you start Social Security income, how much risk you take, from which accounts you give to charity and when. You have complete control over that. And again, when we contrast varying strategies here, some are way better than others based on your unique situations. Spendable income certainly isn't necessarily equal to taxable income, especially those folks buying health insurance under age 65. Great example there. How to save, how much you spend, when and how large a purchases to make, cash versus debt, should you finance certain things, and the list goes on. So now let's spend a little time getting into these, and we'll start with keeping, like, spendable income is not necessarily equal to taxable income. Sometimes people will look at their tax return and say, well, my taxable income was this, where did all the money go? Well, in reality, maybe you didn't spend that much, maybe it was some portfolio income. And the opposite happens too, where sometimes people will spend a lot more than shows on their tax return, because the various buckets of money, if you will, have different tax implications. And if we work from left to right, pension or land rent, that's generally 100% taxable. I'm going to come back to Social Security. IRA distributions, unless you're giving those to charity, those are 100% taxable. Roth IRA, if you meet the requirements, tax-free forever. It's kind of the ultimate. We've got a green that's 0% taxable. And then we have non-IRA down here. That would be where you're only taxed on gains, like in a non-IRA account. And depending how much of a gain you have, that would depend on your the amount that's actually subject to tax. And we have a little asterisk down here because you get favorable capital gains rates, different than ordinary income rates on capital gains. And then we come back to Social Security. We have this huge range of 0 to 85% taxable, and that is largely dependent on all of your other taxable things on your tax return. So like pension or land rent or IRA distributions, not Roth, that's 0% tax-free. So the more you take out of Roth, that's not going to cause more Social Security to be subject to tax. So this is a great example of being able to choose from which account you take money and when. We would kind of view that as as a great option or great control opportunity you have. So taxes, let's go to the next slide here. And it's going to say 23, and I get that we're in 24, but a lot of us are probably still thinking about 2023 taxes. And this is for a married couple, married filing jointly. The concept is the same for a single person. The numbers are just cut in half. The income amounts are cut in half. So the same concept applies here. So these are the 2023 ordinary income tax rates. These are not capital gains tax rates. These are ordinary income tax rates. So how it would work is, I'm going to check on time here, about 10 minutes or so. Okay, so the first $22,000 would be taxed at 10%. The next, $70,000 or so taxed at 12%, and so on. Like if you were to go $1 over, if your income was to be $89,451, only your last dollar of income would be taxed at 22%. Everything else would be at either 12 or 10. But what doesn't get a whole lot of headlines is taxes as the law stands right now. And again, Congress can change this at any time. In 2026, tax rates are set to revert back to what they were in 2017 and prior, which for most folks would be a tax increase. So taxes are set to increase in 2026. So if we look at the 10% stays the same, and I'll clear up some of my drawings because it's getting a little cluttered here. The 10% stays the same, the 12 goes to 15%. The 22% bracket goes from 22 to 28, or the 22 could be 25 or 28. The 24 could go to 28 or 33, depending how far in that bracket you are. Kind of the crazy thing is if you look at it, if your income, a couple's income was $364,200 in 2023, the maximum federal tax rate you paid was 24%. Now, if we fast forward to 2026, if your income was $89,451, you'd pay 25%. So in that last dollar of income, you could have whatever that is, four times the not quite that much. But yeah, you could have 4 times that much income and still pay a less percentage on that last dollar. So as we look at things, again, from which account you take income and when, maybe there's Roth conversions, maybe there's, realizing capital gains or taking capital losses, or certainly, depending on your unique situations, likely some things we can do to try to optimize your tax situation for now and in the future. We generally don't want to just minimize your taxes like right now, like to pay 10% now only to have to pay 25 or 28% later because you're deferring income and your income's going to be higher in the future. Probably doesn't make a lot of sense. And I'm generalizing here as it's unique to your situation. So we talked about inflation earlier. Inflation for things going up, of course, is not ideal. It costs more money. But in terms of taxes and how they do the tax rates, it's helpful. So if we look at this number here, and I'm using this as an example, the 89,450 number, that's the top of the 12% bracket. For a couple, a single would be about half that. So these are the 2024 brackets here. So we can see that the top of the 12% bracket is $94,300. So about $5,000 more of room in that 12% bracket. I spend a lot of time on that 12% because anything above it goes to 22. Not quite, but almost a doubling of the tax rate. Another number we spend a decent amount of time is this number here, the 364,200. Why? Well, that's at 24% right now. And the next rate above that is a 1/3 increase, 32%. So if we look at that number, 364,200 right now. And if we look at 2024, that number goes to 383,900. So with the inflation adjusting the tax rates, there's quite a bit more room now in the 24% bracket. And when you look at, again, if you're still working and you're looking at making like pre-tax 401k contributions versus Roth contributions, and you're a high earner, and based on where you are with that, if you're around that number, that's a pretty big choice of pretty big financial difference of if you would choose pre-tax versus Roth. And again, if your income's that amount, you're not going to be able to make a Roth IRA contribution, but you could certainly still make a Roth 401k contribution. Yeah. So that's where tax rates are. So let's take a moment. We'll do a quiz. We may go a little bit over on time. I think 4:45 was the allotted time, but I got a little more to share, so feel free to stay on. We're going to talk a little bit about the cost of Medicare, but let's take a moment, a little bit of a quiz. Again, I'm not going to do a poll or call on anyone or anything like that. But if you think about, we're going to go back to, I think it's like 1913 here. Think about the lowest and the highest tax bracket for the top federal tax bracket. So right now we know it's 37%. In 2026, it'll go to 39.6. But what is the top, going back to 1913, think to yourself, what is the lowest and the highest? And there's going to be several caveats to this. So this is more so kind of for fun, if you will. But let's go, here's the top federal income tax rate by year. So here we are, 2000, again, when 2018 is when tax rates changed. The top rate went from here, 39.6 to 37. And again, in 2026, right here, it's again going to go to, unless Congress acts, it's again going to go to 39.6. And that's kind of about what the top bracket has been ever since 1990, 1993, 30 years or so. It's kind of been in that, call it 35 to 39.6 range. The lowest would have been back in 1913, 1915. It was 7%. And then the highest, I think in, 44, 45, up in that 90, 94% range, all the way through 63, it was in that 90. Granted, the income amounts were much different, but so there's probably more to the story than what this shows. But sometimes it's a little bit interesting to look at a history of the top federal tax rate here. So again, for the last 30 years, it's been fairly similar. But just a little bit of trivia, if you will, there. So 2024, there really aren't any tax changes at this point, but there's something to be aware of that we'll be sharing with folks is for those of you who have a required minimum distribution, so generally age 73 and over, your required minimum distribution is probably going to be a decent amount higher than it was in 2023. Because your required minimum distribution is always based off of the prior year-end value. So for 2023, we would have looked at December 31st of 2022. And in general, the markets were down in 2022. So for most of you, your RMD, required minimum distribution, would have been less in 2023 than it was in 2022. So maybe less tax issues, tax surprises, if you will, for 2023. Now, if we flip to 2024, look forward, most folks are going to have a required minimum distribution that's a decent amount higher in 2024 than it was in 2023. Two reasons. One, you're a year older, and the way the government does it, you have to take a little larger percentage out every year you get a little older. That's one. Item number two is, for most folks, your account value probably went up a decent amount in 2023. So when they take that percentage, which is a little bit larger because you're a year older, multiplied by the 12/31/23 account values, which would have been kind of a high point in the market, required minimum distributions are going to be a decent amount higher in 2024. So there's several factors that you have to be aware of and things we look at, one of which happens to be, I won't go into all of them here for the sake of time, but I'll mention one. This is going to be what they call IRMA surcharges. So if you're on Medicare or you're going to be on Medicare, let's say if you're 63 or older, if you're 65 or older, you can be on Medicare. But the way they do this, it's a 2-year look forward or look back. So if you're actually age 63 this year, your income is going to matter for how much you pay for Medicare when you're 65. So this is like the 2023 chart here, which if I highlight was based on the 2021, what they called MAGI or modified adjusted gross income. And they have both single and married filing jointly on here. And if your income for married filing jointly was $194,000 or less, you did not pay a surcharge for Part B or D. But don't let that $194,000 can be a little bit deceiving, I should say, because that modified adjusted gross income is not your taxable income. That modified adjusted gross income is going to be your number, like your adjusted gross income with some modification. So it's your modified adjusted gross income is much higher than your taxable income. And if you go $1, it's like a cliff. If you go $1 over that, let's say your income was $194,000, $1 You have a Medicare Part B surcharge of $65.90 and a Medicare Part D surcharge of $12.20, which is total $78.10 a month, which doesn't sound like maybe a lot, but that's per month per person. So it really adds up. So that's for last year. And then this year with inflation, the numbers are higher. The reason I'm mentioning this is for a lot of folks with what happened in the markets in 22, 23, it didn't catch as many people. It's going to potentially catch more people in 2024. So it's something as you're going through things, sitting down with your advisor, something that would be a very good topic of conversation as you look at taxable income and modified adjusted gross income, or MAGI, going forward. But these numbers are a decent amount higher. So again, the inflation helps you a little bit there. So it was what, 194,000 last year. Now it's 206,000. Again, this is 2024, but it's based on the 2022 modified adjusted gross income. So some things to think about there, as sometimes the movements of the market can impact your tax situation with how much you take out of accounts. Also, if the markets, let's say they do well in 2024, there may not be really any losses to take. Sometimes we do move things around to give you a tax benefit if you have something that's temporarily or down in value. There may not be as much of that. So let's see, again, any questions or chat boxes, feel free to put those there. We'll highlight as we do the Dream Architect planning process. Whoops, I'll get those drawings off there. Is the 4-step process for those of you who are clients on here that we go through with you in the ongoing review process of vision, blueprint, build, and maintenance. My email address is here, Oliver at Sweet Financial. So if you have a question, I certainly do check that, and I will certainly reply. So any questions or anything you think of later that you didn't ask here would be, feel free to give me a call or email me. Again, Oliver at sweetfinancial.com. So wealth management is what we do, inspiring you to realize your dreams are still possible, is who we are, and that's really the essence of the Dream Architect. So I hope you enjoyed the information this afternoon. I wish you a wonderful evening, and we always want to thank you for your continued trust and confidence. And I'm getting a few items coming through the chat, kind of saying thank you. So I appreciate the kind words. Again, any questions or anything we can do to be helpful, always feel free to reach out. So with that, we'll conclude, and I'll wish you a wonderful day. Thank you.